It seems like the price of gold is hitting a new all-time high almost every single week, and central banks are stacking gold like never before. We're also seeing an uptick in demand for physical gold here in the Western markets, and I think there is something big brewing in the precious metals industry right now. And today we're going to be joined by somebody who's been tracking this from the inside. His name is James Anderson. James, welcome back to the channel. You've been stacking and following the gold market for what, nearly 2 decades now?
Yeah, I've been 15 years or so. So yeah.
Yeah, it's awesome. I follow him on Twitter. I watch his market updates every week over on his channel in SD Bullion. But James, today what I wanted to bring up is gold has been showing really strong. We've seen central banks buying in the gold. There's been a rush on gold in places like Vietnam where they're literally lining up out of the door to buy gold as fast as they can. But inevitably, whenever we see gold rise like this, whenever it crosses another $1,000 threshold, there's always a fight, right? So what happens when we see gold inevitably dip back below $3,000? What's going to cause that to happen? What happens when it, what's the reaction when it does happen? Can you kind of touch on that with us today?
Sure. If you look at like a long-term chart of gold and, relative to its 200-day moving average, generally the 200-day moving average is kind of in a bull market for bullion. It's kind of like the lower ballast. It's basically like occasionally it will dip below the 200-day, and it's done it before. Like for instance, in early 2008, gold had ran beyond 1,000, and that was a big nominal mark, to go past 1,000. And then the global financial crisis came about, and we had spot price recede by 30% or more, down to 700 spot price. And that was below the 200-day moving average at the time. Of course, at that time, people were really worried about banks, really failing, and they were so concerned that more or less the wholesale and retail bullion market basically went to low inventory. There were days where we literally didn't have inventory on our website. And for a bullion dealer, that's not good, right? Where you actually have no way to take any orders. Like literally, you have the AP desk won't answer the phone. There's no way to even place orders in back order. And there were stretches of like 2-3 month delivery times at those times. And so, you have a situation in 2008 where it went above 1,000, it dipped back below 700. Then they began, the beginning of QE started, and it was very quick before it went beyond 1,000 and started marching onward to 1,900 by August 2011. So that's just one example of the $1,000 mark. The $2,000 mark, as people probably remember if they've been watching this market the last 5 years, we kind of struggled back and forth there in that channel for 3 years, kind of basing back and forth. The Russian invasion, Ukraine, the freezing of Russian assets, which is probably one of the most important marks, at least in the 2020s, in terms of gold buying. That really was the canary call, I think, to central banks around the world, to let them know that, hey, it's not just your U.S. treasuries, like wherever they're parked. Basically it could be in the U.S. or it could also be in the EU. They'll freeze them if they essentially don't agree with what you're doing as a sovereign nation. And so that's, I think, what really has increased. When you look at central bank buying in the last 3 years, on a historical level, if you look back 70 years, going all the way back to World War II, to buy 1,000 or more tons and admit it transparently, like in terms of the various organizations that deliver that information year in, year out, to have over 1,000 tons per year is much larger than it's ever been prior. In terms of notional gold tonnage that's been bought, it's the largest in scale in history. So you could go back, I suppose, during World War II and see some of the physical gold flows, because there was a lot of gold moving around because people were worried about Nazi invasion and taking of gold reserves, et cetera. So there was a lot of gold that got moved, say, from the United Kingdom over to Canada and stuff like that. And the United States at the time was a gold powerhouse. Basically, we were supplying a lot of the military and all the industry that World War II needed to gear up. And so we were a manufacturing powerhouse back then. That's kind of what made us into a gold powerhouse. So the gold flows in World War II were big, but they're not even close to what we have now, which is you just have a situation where central banks are moving out of the bond market, out of the treasury markets, and they're moving more to bullion. And that's just a huge thing. I mean, that's a phase transition to understand that now we're moving into a phase where bullion over bonds is really the call for a lot of sovereign wealth funds, a lot of central banks, a lot of major players in financial institutions. They're going to start moving a lot more into bullion. And when you have flows like that, capital flows into bullion, it re-rates and revalues bullion versus relatively every asset class that you could think of. So it's a situation where you'd have markedly higher gold values in relative basis to bonds, stocks, real estate, et cetera. And that's kind of the phase transition we're going through right now. There's one other thing, like in a bullion bull market, if you go, typically it will go down to the 200-day or it'll go near it. And generally, if you look at it on a long-term chart, it'll go down and it'll kind of bounce off and re-levitate, essentially. So I think the 200 days at like 2,630, 2,640. And, like, for instance, what could happen? You could basically have a situation where, say, Russia, Ukraine have a peace accord, and all of a sudden there's like a major dip in the gold price because shorts essentially can just say, look, that was a huge war premium that was on gold. And so, we float back down to 2,800, 2,700, 2,600. And people in their heads are going to start freaking out, thinking, at least the unstudied ones are going to think, oh, well, that's gold's high because it was the Russian war premium. So sell, and they'll freak out. But you have to understand, this is not about the Russia-Ukraine war. This is a lot bigger of a bullion bull market. Gold has a lot more to go because it has other things it's worried about. Not simply a war premium. We're talking about 100, 200 trillion in United States unfunded liabilities that have to come due in the next few decades. And if you look at the European Union, I mean, the amount of unfunded liabilities they have is just gigantic. So to write that off or to come to terms with the social contract in these countries, that's going to take decades to play out, I think. You're talking about a gold bullion bull market that could stretch well into the 2030s.
So if we stretch it well into the 2030s, I mean, to me, it just looks like we're basically rejecting fiat currency in general, like not just the US dollar, but currencies around the world. People are moving back into that physical asset. Like you said, hundreds of trillions of dollars that we have to account for in just a couple of decades. We don't try and predict spot prices, but where do you think gold could go if we really find ourselves in that kind of situation?
So when I look at like a long-term basis at gold, I just look at it on a historical basis where it's gone before in prior bullion bull markets. So a lot of times I'll use 2011 as kind of a conservative target, because this right now it's a lot bigger bullion bull market than 2011 was. 2011 was kind of I don't know what you'd say, like an appetizer before the main course, right? I mean, and 1980 was a Western-led bullion bull market that really called into account the amount of prolific currency creation around at the time. So the 1980 gold bullion bull was a major gold bullion bull. It was so big that for a couple of years we could have theoretically gone back on the pseudo gold standard. We had 40% coverage easy. There was a little bit of time where we had 100% coverage of the outstanding US dollars, at least internally in the United States. So my expectation is you're going to find anywhere beyond 2011's peaks back toward the 1980 in like a mania phase. And so, when I look at long-term charts, those are kind of the two targets I look at to kind of gauge as to, well, how crazy can this get? And, to be quite honest, it's basically I just think it's a huge transition in terms of people going away from things, counterparty risks, promises that just literally cannot be paid. I mean, you have promises that have been made that the only way that they can nominally be paid is by devaluing the currency units over time. And that corrodes confidence, right? And so when you have a corrosion of confidence, what ends up happening is people want things that they know they can, in their hand, that they own outright, and then no one can take away. And so that creates a huge premium for bullion, in the physical form.
So where does silver come into play? I mean, we're looking at what I consider to be an unsustainable, like 90-to-1 silver to gold ratio. Silver generally follows gold in suit. Do you think that it's going to have its heyday here soon, or what's going on there?
Yeah, how soon is hard to know, right? I mean, that's a very difficult thing to say. But I think in general, you'll have in a bullion bull market, gold generally leads, silver will eventually follow. There's always been times of frustration for silver bullion bulls. In like 1976 to 1978, you had an intermediary cyclical bottom for gold and silver. And 1976, toward the end of 78, gold outperformed silver. If you look at the gold silver ratio back then, it was kind of running from a channel of 40 to 30. And I'm sure silver bulls at the time were frustrated. But then, the start of 1979 to the beginning of 1980, in like a 12-month run, you had essentially a threefold outperformance of silver versus gold. And the spot GSR went back down to the mid-teens. In 2009, or no, it was 2010. In the beginning of 2010, toward I would say, it was 2009 till about August of 2010. You had a situation where the gold silver ratio was rising. Gold was rising and silver was not keeping up. People were getting pissed. You had basically the QE situation. They're like, why isn't silver reacting hard? and it took a while. But then August 2010 until May 2011, you had a major gap up in terms of the gold silver ratio in that time frame. And so I think it bottomed in the low 30s in 2011. So here we are again. We're roughly the 90 level. If you have a 3x outperformance of silver versus gold, you're back down toward the 30 level. And my expectation in a mania for silver is that the 2011 low of the low 30s, I think gets blown beyond. And you'll get to a point where it gets really stupid, where people start saying, silver's the new gold. Like there'll be all these silly silver wonks coming out of the woodwork. You'll have everybody and your brother talking about silver and how it's the new gold and that kind of thing. And that's when you probably should be taking some profits out of silver and moving into other asset classes, or perhaps buying some gold for the long term, or platinum, or whatever you deem to be, something that you want to store value in. Because silver is a volatile metal. My expectation is not to have silver go back down in the teens and just stay there. I don't think we go back on some type of pseudo gold or silver standard and you basically have a situation where silver stays in its teens. I think that it'll spike down and it'll go down there, and it'll probably be a year or two where you'll have it majorly outperform gold. And it's in that time frame that you kind of want to be looking elsewhere, at least taking some profit in silver and moving it elsewhere.
When you say that silver is going to outperform gold, we are specifically talking about silver catching up to gold, not gold just kind of getting weak so that silver has a chance to catch up, right?
Oh, correct. Yeah. I mean, gold is going to perform nominally. And for it to go to 5 figures an ounce, to me, is a no-brainer. It's a question of how badly we're going to devalue the currency units around the world. Ultimately, gold is going to revalue in relative terms, which is most important to, say, the S&P 500, right? Right now, I think it's around 1.8 and change. I mean, there's been long durations of time where 1-to-1 S&P 500 versus gold. So what's the S&P 500, like 5,700 now? So you're talking about a 1-to-1 is kind of normal in the long term when it comes to relative gold versus the S&P 500. And I'm talking about major time spans, like 120-year time spans. And so for it to get to 1-to-1 is pretty normal. And for it to blow beyond the S&P 500 happens a lot in major bullion bull markets. There's situations where it's gone to 4 times the amount of S&P 500. So think theoretically. I mean, you have 5,700 S&P, 4 times that, you're talking about 20,000 gold. I know these numbers sound stupid, but the idea that Bitcoin was $80,000, we've already been preconditioned psychologically to think, well, Bitcoin can go to 6 figures. I mean, gold could go, low 5 figures easy. And so that's kind of the rationalization. The human psyche has to get used to that. But I think we've been preconditioned a lot with the bubble that happened in cryptocurrencies, and that's still going on, I think.
So earlier we were talking about central banks and their massive gold buying very recently, actually. What happens when central banks start selling their gold? What do you think that does to the market? Will it tank prices? Or do you think they'll even do it? I'm sorry.
No, that's not happening. This is not the 1990s. This is not some situation where gold leases are exploding. The gold lease book is actually imploding in the face, which is exactly why you have a problem in London. I mean, the gold lease book is unwinding, essentially. You have Basel III coming on this summer. You have banks who, if they want, can declare gold as a tier 1 asset on their balance sheets. And you're going to end up seeing, probably before this is said and done, banks going under that are short bullion, that have to deliver, or that are on the wrong side of this trade. Because when bullion gets going, there's usually a bank or two that get caught on the other side. In early 2008, I mean, that's partly what led to Bear Stearns failing. They were on the wrong side of their book in terms of silver, for sure, and gold. And they were getting their heads handed to them in the commodity markets because commodities were just exploding in early 2008, and Bear Stearns went under. So my expectation is, you're going to have banks failures at some point, or some major banks getting caught short and having to catch up and taking massive losses. And of course, on the other side of that, there's going to be banks who are going to be making lots of money as well. Don't think for a second in this bullion bull market that the major commercial banks aren't going long. And when the time's right, they're not going to make their math. I mean, that's a guarantee.
Do you think that the demand for gold that we're seeing from central banks, and then what we're seeing in other countries, like I brought up earlier, Vietnam, and them buying a lot of gold, do you think that's going to lead to a shortage of physical gold available for people like, me and even you that want to invest in physical?
I don't think necessarily right now that's an acute threat. But I do think ultimately when you go into a mania phase, that's going to occur in the United States and Europe and other places. I mean, right now you hear of it, little reports of it happening in places like Korea or in Vietnam, where it's, you got to stand in long lines, you get limited to an amount that you can get. I think the report that I mentioned last week at SD Bullion's YouTube channel was that in Vietnam, people are waiting for hours depending on the store, the minimum is like one towel, which is like 1.2 troy ounces of gold, down to like one gold ring, so like you have people around there, they're asked, kind of just randomly, they're asked why they're buying gold. They're thinking, their mentality is, I have extra cash, so why sit in cash? That's the mentality that becomes, in a bullion bull market. It's like, if I have excess cash, I'm damn sure not going to leave it in the bank, because whatever rate they're paying, he's not staying up with inflation, because that's just the way the system has to be. I mean, they basically are going to tell you, yeah, the interest rate, we can pay you is 5%. The truth of the matter is inflation is at least 4 or 5% beyond that, probably worse in a lot of these countries. So a lot of people just run to bullion if they can. Another point is in Asia, like you even have Japan now, where they're starting to buy a lot of gold, and you have people out there banging the table. I'm gonna mispronounce his name, Bruce. He's like the leader of the Japanese gold market. He's out there on LinkedIn, and he's doing videos in Japanese all the time on YouTube. And I go and look at his videos, and he has like 20, 30,000 views, like in any type of interview. He's got a book out, talking about gold in Japan. And, Japan, for people who don't understand, per capita has a lot of wealth. If you have a major flow of private investors in Japan who start buying gold and bullion in physical form in large quantities, I mean, they have a lot of savings, the Japanese. They're wealthy. That's a wealthy island. If you see them start moving into gold, and then eventually platinum and silver, that's gonna create a major buying sector. And the thing about, it's kind of like this rabid thing when it comes to bullion. We have this thing in our brains, like the lizard brain. There's like this psyche thing that all of a sudden, like you get enough people feeling, the FOMO, or they're gonna miss out, and you get this irrational buying spree. And that's I think where we're going toward. In a mania phase, that's exactly what you get, is an irrational, I have to get the bullion, I don't care what it costs type mentality.
So James, just on a short-term basis, where are we looking at in price action for gold and even silver?
All right, let's see. In terms of gold, we're still hovering above the important psychological 3,000 level. Now, I suggest people that we are going to go below 3,000 at some point, but we could definitely go beyond and go to 31, 32, 3,300 before we do the retracement. Silver, we have a situation where, last few days it's sold off a little bit, but it's popping nicely today. It's 33.60 an ounce right now, spot. On like a technical basis, when you look at it, just visually on the chart, it could easily pop back toward the 35. 35 is like the critical level. So if it can get beyond 35, you have a situation where it could run toward 36, 37, 38 even. I would think if you had a run like that, that's when if you're a short-term trader, you need to be, unwinding and taking some profits. What you'll probably see is, if there is a pop in silver, a run toward around 37, 38, and you'll see a retracement back. And this year, I think it's pretty conservative. Any bullion bulls out there, at least that are asked on silver, the general conservative bullish call is 38 high to low 40s high. Sometimes you get people who say this year it could run beyond 50 or 250. I'm not sure it's in the cards this year. Whether or not it's this year or next year or 2027, I don't know. But the $50 an ounce number is going down at some point. It's just a question of, what are the conditions that drive it to there? And that'll be, that's the final boss, right? I mean, the final boss is getting beyond the 50 an ounce level. And once you get beyond 50 an ounce, you stick it, the landing, and it's now support. That's when, silver starts going crazy and starts really outperforming versus gold. So, there's a lot of fighting and a lot of battling and back and forth till then. That's what generally happens in a bullion bull market. You go through this thing called a wall of worry, right? You're just climbing and everyone's worrying and they think the bottom's going to fall out. And I bought silver back in 50 in 2011 and it's near 50 now. I'm breaking even and I'm selling it, that type of thing. Like, you'll have all that stuff going on. But eventually, all the people who've been telling you for, I don't know how long, decades, that silver has the potential to do something incredible are going to be proven true. Granted, they'll be broken clocks for decades like myself, but eventually we'll be proven correct. And, the question is, like, will you have a position? Will you be ready psychologically as well to be able to handle that and trade through it and be intelligent about the way that you handle your position? So I think that's the idea. In the short term, silver could easily pop toward 35, 38. Gold could go 3,200, 3,300. But I'm talking more on a long-term basis, the psychology of what we need to be thinking.
Okay. And speaking of long-term and short-term for that matter, Citibank's actually calling for gold to hit $3,500 by the end of this year. Do you think that's feasible?
Yeah, it is completely. I mean, it's a question of, can it do it on a straight line, or are we going to have to go through some correction over the summer, perhaps, and then a resurgence from who knows what. Like, it's very difficult to know exactly what are the drivers on the short term, because the Trump administration and all the things that are happening geopolitically that can drive headlines and drive the sentiment. It's hard to know exactly what that will be, but we've already started off with a bang. I mean, this is only the first quarter, right? I mean, I look back at, like, for instance, LBMA always has these guesses. They have 26 different analysts who come out and they make their guesses about what gold and silver are going to do for the year. We're not even done with Q1, and half of the 26 people that they asked on gold, their highs have been blown past, right? I mean, like, so the consensus of these 26 experts, half of them have already been proven wrong on gold, right? And that's just a quarter ago that they made these guesses, right? And so we're just through Q1. We have 3 more quarters to go. I'm not sure exactly the gyrations, but 3,500 is entirely reasonable for this year, I think.
Okay. Well, James, I think that's all I had for you today. Was there anything else you wanted to add before we go to let the viewers know? Anything that I missed?
I suppose, just check out every week on SD Bullion's channel. I come out with an update, market update. It's free. You can just come and check it out. I usually drop it late on Friday after the markets close. So it's, say, late Friday or early Saturday mornings, you come by SD Bullion's YouTube channel, check it out. And of course, SD Bullion, you come to the website and buy your products. I think we have a really good deal right now on 99-cent Mercury 1 ounce rounds. And I was kind of thought about buying those. So 99 cents an ounce over spot is a pretty good deal for those. They're kind of pretty. So SD Bullion YouTube channel. I would suggest people go check it out.
All right, guys. Well, I'll link that down below in case you're not already subscribed. I'll also link you to James's X account, which I do follow myself. He posts on there sometimes it seems like 20 times a day. Is that right?
Yeah, sometimes I'll go through a tweet fury and just light it up. Sure.
Awesome. Well, thanks for joining me, and I hope to have you back on soon. Guys, again, James Anderson from SD Bullion.